everybody. Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host every Tuesday night for Zoom at 8. And tonight is going to be a special one because we have the infamous Nick Moore with us tonight. So we are going to be excited to hear from him, but let's get started. Again, my name is Julianne Peterson. I am with Old Capital Lending, and we are a premier provider of debt, especially for multifamily. We got started at this 38 years ago. And so if you are working on something in multifamily, we'll do other asset classes, but if you're working on something in multifamily, we'd love to take a look at it. T12, rent roll, OM, you got some underwriting, I'd love to take a look at it. Now, if you've been watching TV or listening to the radio like you used to do in the 50s, I bet you've heard some kind of not so fun things going on in the lending business, in the banking business. Oh my goodness. SVB is no longer closed. Bye-bye. Who is next? Signature Bank, FDIC, under their control. Who's next? So we need to be making good decisions on the assets that we are purchasing. So, always, always, always be making good relationships with sponsors. If you're an investor, if you're simply a limited partner, you got to be thinking about who is at the head or flying this plane as the captain of this plane. Who is flying it? Make sure that they have been doing this for a while. This is a relationship business. So make sure you have somebody that knows what they're doing. And they also come here to Zoom at 8. You will find these people here at Zoom at 8. We've been doing it for 4 years. So if you're new, you might not have a Rolodex, and that's why I created Zoom at 8. Let's get on with the show, because this is the meat and potatoes of the meeting. And this is why we all got here. So before we go, let us all give our focused attention to me. Go up to the right-hand side of your screen, go to speaker view. You see it right there? Oh, I see Damone on my screen. Hey, Damone, nice picture. All right, so we're here to see Nick Moore tonight because Nick Moore is a good friend of mine. And Nick Moore is somebody that you're going to want to know. Nick Moore is very relatable, hard to understand because he's an attorney. Most attorneys speak over your head. I don't know why. They would probably get more business if they would just become more relatable like Nick. So Nick is a partner in the real estate and private equity practice group, handling virtually all transactions involving income producing commercial real estate. With several years of experience, Nick represents local, regional, and national developers, owners, syndicators, general partners, limited partners, and investors as they acquire and divest commercial real estate through sophisticated transactions. He uses his experience to provide straightforward, actionable, and practical advice with the ability to refine clients' strategies for acquisitions, development, leasing, financing, and joint ventures. Nick's clients are focused predominantly on the national multifamily real estate industry, as he has transacted hundreds of millions of dollars in commercial real estate over the last couple of years. He is well-versed in matters relating to advising and structuring joint ventures, syndicating real estate acquisitions, guidance through divestments, as I mentioned, and creating real estate private equity funds and private investment companies. Listen to this. He has, over the last 2 years, been selected as the Georgia super lawyer as a rising star the last 2 years. I'm wondering if he's going to get it for 2023. That's the question. This exceptional award has been provided to him because he's been the top 2.5%, 2.5% of the voters earned for the area of business and corporate. He has spoken and appeared at numerous conferences, summits, podcasts, and other local engagements, sharing his knowledge and experience. I mean, I am just so excited tonight to have Nick Moore here with us. So let us give our focused attention to Nick Moore. Nick, how are you tonight?
I couldn't be better, Julie. This is exciting. Thanks for reaching out and scheduling this. You know, it's always a blast when we chat. And I did get Super Lawyer again this year. We need to update our website where we pulled that. I don't know who's voting for me, but thank you. They don't know me
Nick,
well enough.
When I met you, I just felt so lucky that I came upon your presence. I just think you are the shadizzle. And I don't say that about too many people. So when I find people I like, I feel like they're like peanut butter. I just want to spread them all around. And you're like that.
I'm crunchy.
Listen, I think that if I can support somebody that does a great job, I just really want to support their business. So I want everybody to know you. And I want, here's the thing. This is what I want to cover tonight. I want everybody to walk away tonight understanding what is the difference between a real estate attorney and an SEC attorney. So I want you to cover that. I had a conversation last week with Kyle Scully, who is here tonight. And he says, oh, I need a real estate attorney. And I said, oh, you got to call Nick. And
we connected.
I know you did. And
awesome
he said, oh, do I need a real estate attorney? I said, just call Nick. He can cover everything. But I think there is this idea, hey, I need a real estate attorney. I don't need a SEC attorney. So I want you to cover that. I want you to also cover JV deal versus a syndication. What does that look like? How many people is officially a JV deal? And how can that be structured? Can I have 100 people on a JV deal versus a syndication? Oh, I have an LLC. That's one person with 100 people under that LLC and another 100 people under this LLC. That's only 2 LLCs. So I want you to really unpack that for us. Yeah. And then the third thing I want from you is, in this changing economy, Nick, there's a lot of challenges. And one of the biggest challenges today is there's going to be some JVs or GPs are going to be facing some challenges. There's co-GPs that everybody jumped on these deals. Oh, I'm a co-GP. I brought 5 people. Did they do it correctly?
Yeah.
And there's a lot of people that maybe didn't get into these 506Bs correctly. Do they have a substantive relationship?
Mm-hmm.
And when you're maybe pre-existing, and when you don't, when you're not making distributions, there's going to be people coming out of the woodwork, right? And how can you protect yourself? All right. And then lastly, I know I only had 3 questions, but I do want you to cover
3B.
this.
Mm-hmm.
Yes.
And you'll need to refresh me because I might have already forgotten the first one. But
all right, well, I'll get around to that.
Moderate.
But, okay. There are a lot of people in these bridge loans, and we're going to see some deterioration in this marketplace. We are already seeing it. And there are supposedly maybe some bridge lenders that are maybe not providing the level of service that they maybe should be. Or maybe there are some general partners that are not providing, they're not doing the level of performance that they should be. We don't know who is maybe providing it. From an investor standpoint, maybe people are seeing some faults. I want to give you a case study when we get there, and I'm going to look for some feedback from your standpoint, from an attorney standpoint, how you can help us.
Yeah.
Okay.
Awesome. Well,
I want
yeah.
this
So
to
the
be a
first,
little interactive too. So if anybody has
ask the
some
question.
questions, you guys know where to find the question, the hand raising. Okay,
Love it.
Nick, are you
I'm
ready
ready.
for this?
I'm ready. So
All right.
let's distinguish the real estate and securities attorney. So I think conventional wisdom is they are two completely different sophistications. They're definitely two different practice areas. You know, when you develop your legal career naturally, and hopefully, maybe not naturally, but hopefully you're pursuing something that you know, you have a natural interest in, a natural aptitude for, and that you are enjoying the work that you do every day. And so if you're a securities attorney and you don't like real estate, wouldn't suggest you do it. And if you like real estate and you don't like securities, I wouldn't, you know, advise pursuing that. But there's some weird guys like me that are absolutely obsessed with both of them. And so it's the perfect marriage in multifamily, as each and every one of you know. The syndication of real estate has really burst on the scene probably 10 years ago. Okay. And this was not something that we could really do before because a lot of the rules changed around 2012. The access to private placement capital unlocked these opportunities for, you know, for us investors and people trying to, you know, break into real estate when, you know, preceding that, most people kind of just had to qualify and build up their net worth. And it seemed like real estate was only a game for the super rich. And so syndications have just brought that to hometown USA. And look at how well all of us are doing. I mean, it's just absolutely incredible. And so for me, I actually, when I look in the mirror or in my Zoom thumbnail, I see a real estate attorney. It's just always been my passion, and it's just transacting land and is just great. Working through purchase and sale agreements, representing clients on their corporate stuff, being able to work with you know, just first class folks like Julie. I mean, it's just it's amazing. And so I started my career in real estate, and then I'm linked up with a friend of mine who was needed some overflow help. He's like, hey, I'm bringing on these clients, and you know, I'm just getting stretched thin. I'd like for you to take a look at some of these documents for me, and you know, using your corporate acumen, if you could just put some eyes on these and work on the documents, I'd appreciate it. And so that was my first exposure to these securities offerings, and I was like, wait, what am I reading? What is this? You put in how much and you get what back? You know, and it was just like all of you. I mean, it was mind blowing. It truly was. And then to realize that I could actually make money and then take that money and invest it into some of these deals. And now I'm just so blessed and fortunate to have several deals a month that come across my desk that I get to represent operators of all differing sophistications. But I'm a one-stop shop. I also own a title company. So we work through survey, we work through title. I'm licensed title agent in Georgia. Outside of that, we try to source Old Republics, either national office or a local agency for Old Republic, and just make the transition or the transaction seamless for you. Really, you know, throughout the entire deal. And so you're not getting multiple invoices from attorneys. You're not trying to link up your real estate attorney with your securities guy. And then this happened the other day because I do have clients that do have real estate attorneys. And look, I play in the sandbox. You know that, Julie. I have no problem whatsoever. You are the CEO of the relationship. Whoever you need to bring into it, I'm happy to you know, to collaborate. And so we were on a deal that we're closing this week on Friday. This one's actually in Kansas City, and it was the lender had reached out to me about this, and I was like, oh, sorry, I'm just the securities guy and doing the corporate stuff. That's more of a real estate and title question, and take that to next counsel. And here's the lender's counsel. She's got to go back and retype the email and do all of that. And so by putting everything with me, everything's accomplished. There's one conversation. We can answer everything from the securities raise itself, do the purchase and sale agreement, and then we have full visibility and we know where we're at in the deal throughout the entire transaction. And it's just been said to me that convenience and peace of mind, knowing that they can concentrate that in one firm. You know, I am bigger than myself, fortunately, or my firm is bigger than me, I should say. And so we pull that in and put it through our workflow, and you've got this whole machine behind you in your deals. And yes, we've been fortunate to transact a lot of deals that way, doing both the real estate and the syndication.
All right, my question in regards to whether you're a real estate attorney or you're an SEC attorney, these deals come and they might go. How do you, when you get into a deal and it falls out, how do you get, how do I pay you or do I know that is a question. People
So
ask
it
me
is.
and I say, well, I don't know. So let's get that out on the table. Because I
So
don't get paid unless it closes. So how about you?
so nobody should. I get it. I get it. Just kidding. So that's a very good question. The short answer is I'm a human being. So I'm going to have a conversation with you about, look, if this deal is going south, what does it look like? Normally, the prospect, okay, it really depends, Julie. If most of my clients know they're going to be able to complete the raise before they even start it. Okay.
That
And
would
so
be in
with
a
that,
perfect world. And I like those types of
that's right.
investors.
Okay. So bring the mentality and build yourself to the extent that when you take that deal under contract, you're actually not even considering the capitalization of it, right? You're just concerned about making sure that you've got a clean deal. And then when you bring it to your investors and your offering documents, that it's capitalized.
Yeah.
If it doesn't happen, generally the first couple of deals, we take an upfront deposit, something like half. Okay. And that's just, there's no proof of closing. I don't know if you're just getting these documents and you're just going to go out and give it a college try. I don't know. I know that my staff are putting their attention and their efforts on your documents, and that's sacrificing the attention that they could pay on others' documents. And so there's a market value for that time and those services. And I'm unashamed to say that from my perspective, the fee is earned. Once the documents are delivered to you, it's not contingent upon your success in raising it. It's whether, if you complete your raise and when you complete your raise, that you'll be perfectly qualified for the exemption, for which we're, seeking safe harbor. Okay. And that's going to be 506B or 506C. All right. Now, that being said, I've parlayed fees to new deals. There's been some people where I've kind of honestly felt so bad for them that I just didn't follow up on the payments. I mean, we're just so blessed in the volume that we have that, sometimes I know, and I operate from the conscience. I think you know that, Julie. And I'm not out here to be like, hey man, tough loss out there, kick over the other $7,500. I'm going to do okay either way. And so it's more of a conversation. But I think the expectation is whether you use me or anyone, that really when you sign up for those documents with the SEC guys, I mean, it's a flat fee. It's value build. It may not take us all of those hours to build it, but there is a market for these documents. We try to sustain the value there. And so just to have that conversation, but ask the tough questions up front, what that looks like. But generally I'm splitting the fee and can parlay the second half to closing. And then once we develop that proof of closing, Julie, then I'll be happy to put the whole thing at the closing table. But I have one client that I've done documents for that owes me the second half, and the rest of them, people pay me. People don't ever actually really ask. I don't even know if I've ever had anybody ask if they can avoid the fee. They either just pay it or I don't follow up. So that's good.
Awesome. Good. All right. Any questions on real estate attorney, SEC attorney? Any questions on that before we move forward? Anybody? All right. Awesome. All right. JV versus syndication. Okay. So we know that JV historically has been a group of people, 3 or 4, 2, 3, 4, right? Who want to buy, in my mind, I'm getting a group of people, 2, 3, 4, buying a smaller building and going to maybe manage it, have maybe a property manager buy, maybe a 13, 15 unit building in Arkansas, as opposed to buying a 100 unit building and pooling their money. Would that be something you'd agree, the difference? JV? Yeah. Okay. Now,
go ahead. Sorry.
Well, so my question to you is, could we structure this JV deal as LLCs, and the LLC is maybe a fund And the fund says, oh, yeah, I've got 100 people under this one fund, and I've got another 100 people under this fund, and I'm pooling my money, but yet it's not really a syndication. It's actually only 4 people, and we are a JV. So if you could clarify that.
Yes, you can do that. There's no bright line test, like there's no number test, like, oh, you have 8, you're a syndication. Where you have to go qualify for safe harbor exemption. In your example, if you have multiple people who are capitalizing through a real estate fund, they are just required to ensure that they're comporting, with their own safe harbor requirements. When you say 100 people under here, my mind immediately goes to like a 3C1 private investment company, because you're capped at 100 beneficial owners, they call them. You have to be extremely careful in a 506B. If you do a syndication, you bring funds in and they're private investment companies, a lot of funds will actually preclude that, because if the fund was created for the purpose of investing in your syndication, then they'll look through that and they'll count the non-accredited investors, if you're relying on a 506B, toward that actual underlying investment offering. And so you can get over the 35 real quick. But let's take for granted that let's say there's 5 funds, if you will, maybe even a sponsor and 4 funds. As long as they're qualifying for their exemption, they can be the joint venture. Remember, those investment LLCs are the ones that are going to be in the joint venture agreement. And then each one of those constituent LLCs is going to be managed by either an individual or presumably another LLC if they're smart. Okay. And so those are the folks that are going to have the decision-making power and have to have decision-making power with respect to the joint venture LLC itself. So if we have joint venture LLC and then we have, investment company 1 through 5 LLC as its members, then the managers of the investment companies 1 through 5 are really going to be tasked with having fairly equal voting rights. Certainly major decisions they're going to be able to, talk about. You can have a manager managed joint venture, in which case one is quite clearly been delegated the day-to-day responsibilities without it looking like a security. But the fewer voting rights that you have and the fewer major decisions you have, of course, the less it looks as though you're actually contributing to the affairs of the business, and then it's tips towards the scale of a security. And then, of course, if it's a security, you have 2 options. One is to qualify for a safe harbor exemption, which is what I do, or you register the security, which I kind of do, and a Reg CF is technically a registered security. But I don't do Regulation A, and I don't do any other Form Ks and register anybody else's security. I want to keep you exempt under Regulation D.
Okay, so for those folks that don't understand what safe harbor is, can we cover that?
Just exemption. That's just the fancy, fun industry term. They call it just the safe harbor, right? Because the safe harbor is, hey, otherwise this should be registered. If you have a security, it's either registered or you're exempt. Remember, some of these nice new 506BC stuff that's been a near-term advent has really helped us. But before, it was register the security or kind of pack up and go home.
Got it.
That preceded my time in law, thankfully, because I've just had the great fortune of being here and having the safe harbor. But all we're talking about are the exemptions under 506B and C.
Got it. Okay, makes sense. So this idea of crowdfunding,
buzzword.
I think you and I have talked about this before. Somebody says, oh, I'm going to invest your $100 into this deal.
This one again.
And I'm going to give you some K1s for that. Yes, run for your life. That is not true.
How much would that? No, I mean, I've never, look, I don't know. Maybe that exists. That's not what I do. That's not how I feed my kids. That's not what I pay for the diapers that I buy.
Listen, how the heck does this Grant Cardone? He takes $1,000 or $10. I don't know what he does. So what what's
My
his vehicle?
understanding is he hasn't called me back, by the way. But
Me neither. I
could
asked
be
him to
his
come
lawyer.
on here. He won't respond.
Can we co-host if he does?
Yeah.
Anyway,
Sure thing.
so my understanding is, and I've never spoken with Grant. I've actually gotten, so what I'm going to give you is hearsay, so it's already unreliable. Okay. But my understanding is that he does a Regulation A,
That's what
registered security.
Charles says. He's Reg A.
Yeah. So the reason why is it's a very cost prohibitive way to go, but what does Grant care? Okay. Once you register your security, you can advertise it up, down, and sideways. You can take non-accredited investors because it's registered. The
Right,
SEC
let's
has
unpack.
passed on the merits.
Let's unpack Reg A, please.
Well, remember, I don't do Reg A. So I'm Regulation D. I go for exemptions. If you don't want to register your security, call me. Okay. But to give you, because I'm distinguishing these things all the time and talking with clients and prospects, because they get into these things and want to know what the available options are. And it's not that I persuade them not to do it, but generally when you tell them it can cost $75,000 to get it going, they're generally like, okay, what are the other options? But again, because Grant doesn't care about that, then he's making the absolute best decision for him. There are some things, because the SEC kind of cracked down a little bit on it because it was somewhat under-regulated, I think, and they cracked down on that to make sure, because there's certain liquidity and net worth requirements that you have to profess and represent and warrant to invest in those. But with the right disclosures, disclaimers, and things like that, you can really get around that. But yeah, he's registering the security, and then he's able to access the masses, and that's where you're going to see. Look, for those of you that would have an interest in it, some of my computer guys, I mean, you could create an app and then do a Regulation A offering, and then you could come up with a handy, and someone could invest in a real estate deal from an app. There's one out there. I don't remember the name of it. It's pretty fancy and looks sleek, and I thought about kicking a few bucks into it just to try it out. But there's one, and I believe that they're operating under a Reg A, because Reg CF is regulation crowdfunding. You're just capped at $5 million. Okay, so Reg A, I think, might be unlimited. There may be a cap, but again, that's the limits of my knowledge on that. And some of you may know my partner Todd Robinson, great guy, great attorney as well, and he's even messaged me. He'll be at a conference. He's like, "Hey man, do we do Reg A?" I'm like, "I don't think so, man." He's like, "Hey, should we try?" I'm like, "I don't think so, man." So we know our lane. We're squarely in it. We're doing great. But if it's the right option, I'll tell a client or prospect right out of the gate, like, "Hey, that sounds phenomenal. Sounds like you have the liquidity to make it happen. Why don't you go ahead and push this out Reg A, and I can link you with a referral that can make that happen for you."
Yeah, makes sense. Okay, so we're in a syndication. We've decided to go syndication. We've decided to go 506B.
Okay.
506B, let's just unpack that for us. And we've decided after a certain amount of time, it hasn't given us enough enough time. What's the right word? Chutzpah. We need to get it. We need more.
The juice
volume.
hasn't been worth the squeeze.
We need more velocity.
Okay.
We're going to get it to a 506C. So
Conversion.
I need to know how long I need to hold it off of the 506B, right?
Yeah.
To go to 506C. So if you could kind of walk us through that.
Yeah,
that is
I've got
a new strategy.
Clients. It is a new strategy. Look, the SEC has been fairly clear. I mean, it's tough to call the SEC clear because they don't just offer up. You can't call the hotline and be like, "Hey, can I do this?" It's certainly not that easy. You're working with what look like fairly rigid rules that were going to be construed more in the favor of the regulator and the investor. But look, if you very squarely and completely qualify independently for each exemption, it won't be deemed to be integrated. And so you just have to perform perfectly in each of the requirements under the respective safe harbor exemptions. So if we start off and we're like, "Hey, we got to call it let's just easy math tonight. All right, $2 million raise." we're going to raise $1 million from the people we know, and we're going to raise $1 million. If we don't get that, then we'll open where we want to raise 2 million from people we know. If we don't raise it all, then we're going to go ahead and convert to a 506C, and then we can publicly advertise and take on accredited investors, et cetera. So let's say in the 506B exemption, we go to all of those persons with whom we have a pre-existing substantive relationship. Let's unpack that briefly. Pre-existing doesn't mean that you knew them before the offering was created. It just means that the relationship preceded your solicitation of their investment. Okay. So the SEC is clear that your first interaction with somebody cannot be born out of the solicitation of a particular security. So somebody's reading the Financial Times at a Starbucks and you're like, hey man, you like finance? Check out my PPM. You want to invest with me? I beat the market, every year. You can't do that. Unless he's like, I'm accredited.
They come to Zoom at 8. And
that's what they do.
They come here every week. And we're talking every week. Rhea comes here every week and she sees Kyle. Kyle shows up every other week. But Rhea has never met Kyle. But Rhea's been here every week. Now, Rhea.
You would. Okay, go ahead. Finish.
Rhea and I and Kyle get in a room after a breakout session. And I say, Rhea, Kyle comes here every other week. You guys have been here. I know you guys have probably talked before. Maybe not. Can she offer him the deal?
And it's a 506B offering that Rhea has?
Yes.
I would not feel comfortable with that. Rhea should not feel comfortable with that, and Kyle should not feel comfortable with that. So I worked at FINRA. I have represented people in front of the SEC. I have litigation in my background. The SEC knows 90% with 90% accuracy the answer to the question before they ask it. And so if they put if they put Ray in a room and they put Kyle in a room and they say, do you know Kyle? How do you know Kyle? Kyle, how do you know Ray? Do you know Ray? Okay. We don't know what their independent answers are going to be and if they're going to vary. If they both say, yeah, we've met several times, then they link up and they're good, just like any old-fashioned alibi, if you will. But if they're like, honestly, I don't really know him, and I didn't really have that many substantive interactions, then it's going to be troublesome. It's going to be difficult to get across the substantive and pre-existing. Let's unpack substantive real quick, because this has a lot to do with this fact pattern. Substantive, based on expert research and opinion, because that's all we have to go on, is if you know the person well enough to know that they understand the investment, that you understand their risk portfolio to a great extent, that you, in discussing deals with them, understand that they know what a waterfall is. They know that the investment is illiquid, that it goes to buy this building and they only own a component of the ownership of that, which corresponds to a certain distribution that they can expect. It's made out of the discretion of the manager. And if there's a preferred return, it's paid first. And then there's a common equity that's paid after all the pref is paid out, right? And they're going to hold this asset for 3 years, at which point they're going to refi, cash out proceeds, okay, catch everybody up, maybe even buy them out of the deal, okay? If they know all of that, okay, then through their relationship that they have cultivated in having these conversations, and it's not just, do you know real estate, it's having these conversations where you can confidently say that you know this person, that you hear the Trinity is the know, like, and trust. I mean, there's nothing to refine there. It's very accurate. It's a sliding scale. It's facts and circumstances. You can meet with somebody 10 times and not know anything about them. And you can meet with somebody 2 or 3 times and get to know them extremely well. So it's more of a qualitative analysis than a quantitative. I have been on podcasts and other things where it's like, try to interact with them at least 3 times. That's just to show that there's a higher propensity for you to get to know somebody when there's a quantity of interaction. But don't forget the qualitative component as well. How well have you been getting to know this person? And so the best way to do that is exactly what you're doing, Julie. Create these opportunities for these breakout rooms. For the people who want to be LPs, it's as important for you to know your sponsor as it is for your sponsor to know you. So get into one of these breakout rooms, be virtual, and go to some of these conferences, because then you're going to establish the credibility, and heaven forbid something happen where you have to attest to the quality or, of the relationship that, is the foundation for this 506B offering. Then you both can confidently say that you know the person, and that you knew that they understood the investment and you had no problem soliciting them for the investment.
Yeah, that's really good, rich information. I appreciate you going over that. I did have an attorney on here that said you're kind of a closed system here, kind of a protected group here. Everybody's we have a password that gets you in, right? You're kind of a closed group.
Yeah. Well, here's the hallmark.
So,
It's a little bit different, slightly different perspective of the same principle. If your communication in the form in which you are transmitting that information could be received by somebody with whom you don't have a pre-existing relationship, then it could be said to be a public advertisement. So what we don't want to do, and what I don't recommend, and I honestly, I've been on, several of these with you, Julie, but I've never seen anybody do it. Nobody's like, hey, I dropped my link to my PPM in the chat bar. You can do that if you have a 506C. I would still caution against it with a 506B. And I don't want to step on any toes, but I would really encourage 506C stuff only, because again, if you could possibly, there's a couple people on here that didn't even chime in, Julie, when you called them out and said, what if we don't know who they are. We're so excited they're here with us, right? But we may not know who they are. And so if we transmit a 506B offering and we put the link of the docs there, and they could conceivably subscribe to our offering, and that person receives that, then that could be the public advertising that's reserved for the 506C only, because we don't need a pre-existing relationship.
Yeah.
We just need that particular investor and limited partner to prove the sponsor takes reasonable steps to verify, but we just say, hey, there's no reasonable steps to verify, prove your accreditation status, use a third-party service, CPA, attorney, something like that we can rely on. And then you can disseminate your information publicly. But just be very careful about, and remember, it's the solicitation. This is a verb. This isn't like, hey, I just want everybody to know I got 120 unit in Dayton, Ohio under contract. Okay. Cool, man. Doesn't sound like you're seeking anything. Reach out to me if you care to know more. Something like that. I mean, just don't put any security stuff in there. You can put in securities disclaimers in there that this is not to be construed as an offering for securities. Only, persons who have received a private placement memorandum and operating agreement, it can be said to have been solicited. So you need the full package of that PPM for it to really and truly be a solicitation. And then really you got to even have the wire, but where there's smoke, there's fire. So they'll pretty much, the SEC will come down on you if you've just made the offering materials available. So just be careful about how you're linking and making the actual offering documents available in your 506Bs. So that was kind of long. Sorry about that.
Great. No, great information.
Julie, I have
very
a
good.
question.
Yes, you're up, JT.
All right. So I actually got asked this by a few friends this weekend. So say Julie's got a deal that she's putting together. Obviously, I know Julie. I've known her for a long time, but my friends want to get in on the deal. But they don't really want to spend the time like I do in all of this. Could they just give me money to invest in the deal for them and get returns out of it? So I've got 5 friends and we all put in $20,000 each. We put $100,000 towards the deal, and then I split up the returns that we get. Is that possible?
You're going to be taxed though.
Well, there's a couple of things there. Taxes is one of the implications, because you'll have to file a tax return on the LLC and send the K-1s around. But remember that, so let's distill it down to its barest form. A security is a profit earned by somebody else's effort. Pure and simple. So JT, if you're in this situation, the only way that you could do that without having to qualify for an exemption from securities yourself is to make that a joint venture. And you're giving them major decisions. You're giving them involvement in the affairs of the company. They're like, look, man, just take my 20 grand. I don't want to have anything to do with this. Just send me the check. I want my mailbox money. You have to qualify for an exemption yourself. Okay. And then that's what I'm saying. If you guys were to create your own little investment vehicle and then you invest into this other 506B, they could look through that and all of your little JV partners would be considered as part of the non-accredited investors.
Yeah.
Okay. So here's where I thought you were going with the question. So I hopefully I answered that for you. Where I thought you were going with the question is whether those individuals could actually participate in the offering directly, right? Like you have a pre-existing relationship with Julie, and she reached out to you and was like, "Hey, I want you to put in this deal, $50,000, and your friends are over and you've got it on the coffee table, and they're like, hey man, what's that?" And you're like, "Oh man, this is how I got this big old house I got. All right, I get a 2x multiple in 3 years, and you'd love it." They're like, "Well, I want to participate. Look, as long as Julie is not soliciting them and she's not reaching out to them, they're coming to her. That's not solicitation." Okay. And they would be available to be able to participate in her offering. And so with those facts just the way they are, if those LPs are the ones approaching Julie, they're available to participate in the offering. And then you can be like, "Hey guys, you sort that out, go directly to Julie yourselves. I'll send you her contact info and you reach out." And now, dude, you're not worried about exemptions. You're not doing K1s. You're not doing anybody else's tax returns and all that stuff. And Julie will have preserved also her 506B exemption.
So the best way to do that, if my friends want to get involved, they really need to then get involved. They can't just really be in the background.
That's the hallmark, because remember, and that's the test. And this is, I was at a Michael Blanc event. I speak at a couple of his workshops, and I was down there in Tampa, and just asked a couple of questions of the audience. Put up a fact pattern and said, what are your thoughts here? And this was actually one of them, your exact circumstances. And so you could say, hey, listen, this is an opportunity for you to get to know this stuff, and why not teach a man to fish, right? And use that the sort of allegory there. Okay. But really, then I have other clients that love that stuff. They're like, "Oh man, I'm a fund manager now, and I'm going to put all these offerings together and do all this stuff." So it's really up to you. But yeah, you have to ask. The first question is to what extent do you expect these partners to participate? And you ever have to encourage them to participate, and then you can put together a joint venture. But the moment that it really seems like they're just going to be passive, then you got to qualify for an exemption.
Gotcha. All right, thank you.
Now, Charles says there is a 35 count to contend with.
Yeah, exactly. I mean, and that's what I'm saying. That's what aggregates. So Julie, you would have the limitation of 35 non-accredited investors. And if you bring in a fund that was formed for the purpose of just investing in your deal, people call it fund to fund.
Mm-hmm.
All right, just for the purpose of investing in your deal, you have to look through to the beneficial owners there. Okay. Now, if it's a variable fund and they can put in anything, then the SEC just says that. Actually, they don't say anything. They just say if this entity is formed for the purpose of only investing into this particular investment, then you look through it. Because think about it, then people would just file your LLC and do what you said, like put all your people under there, and then all of a sudden we have 200 people in a in a 506B offering, and that cuts against the spirit of what we're trying to do. It's really reserved. It's really and truly reserved for those people who are in your closer circle, who and you like, you trust, right? Because you would be less likely, taking the investor protective approach, you'd be less likely to to not defraud them, but coax them, lure them, fill in the blank, put them in a position where they're unwitting unsuspecting, and then of course they lose their money. And that's not the spirit of the private placement safe harbor. The spirit of it is to be able to raise capital efficiently and effectively, but within the confines of those rules.
So real quickly, once you go into 506B and you've only capital raised the $1 million, how long before you have to kind of take it off?
Forgot what we were talking about.
And then you go to the
Yeah.
506C.
So you don't, yeah. So you don't, there's no wait. There's no
There
real
isn't.
wait. There was some comments out there from the SEC about where people had written in and they were like, well, if you do the 30 days, then you're spinning it back. And the SEC was basically like, look, if you qualify for it, we never said that they are mutually exclusive. We just said that you have to perfectly fit into each one of these exemptions. Now, if you're going to convert from a B to a C, it's actually conceptually, it's very simple, because once you convert to a C, it's accredited investors only, and everybody has to prove it after that, because that's the reasonable steps to verify the accreditation status by the sponsor, by the issuer. Okay, the key term is issuer, because they're the ones issuing the securities, okay, to the investor.
Okay, but if you were in a conversation and a 506B, and then you switch to 506C, and that 506B person said, oh, wait a minute, oh, I've decided,
Oh,
you have
bus
to
left
say,
the
sorry.
bus left.
Okay, there you go,
Bus left.
guys.
That's it. And look, I've had clients that had people fill out subscription documents and hadn't wired yet.
Yeah,
And I'm like, that's up to you. Make your own decisions. I would leave them behind.
okay,
I would leave them behind, because they haven't, your subscription is official when your capital is wired. Anybody can fill out the documents. I mean, the true subscription is providing the wire as your capital contribution to the company.
right.
And so that's it. That's all, folks. And I like to convert our PPM. I like to contemplate a separate unit class, and just take those measures just to show the distinct or the distinction between when we had the 506B and when we had the 506C. But again, it's going to be easy, because you can say, hey, here's the line of demarcation. Beginning on April 1st, we took accredited investors only, and you can see all the subscription documents thereafter. We have we took the reasonable steps to verify, and here's the accreditation status.
Okay, perfect.
Yep.
All right, let's shift. Big deal. We're in a changing environment. We're going into some pretty rough waters. Okay, everybody's perking up because interest rates have really changed where, a lot of the environment, right? I mean, from a debt perspective, we're having a hard time getting deals done, right? A lot of investors are having a hard time getting deals done. There's not a lot of volume. There's a lot of buyers. There's not a lot of sellers. There's a lot of banks out there that are on the verge of closing. We have some debt funds that are having some struggles, maybe, that are not delivering, whether it's they're not turning their numbers on their draws quickly. I don't know if this is intentional, but couple things. First, in the general partnerships, these are the times when investors are looking for reasons why they're not getting their money back. What can general partners do today to safeguard themselves from being either investigated or somebody looking for a possibility of being sued, whether they didn't file their paperwork correctly, they didn't have a substantive relationship, maybe they have a bunch of co-GPs that maybe, how co-GPs go. What is your words of wisdom right now? Because this is some very concerning times for general partners.
Yeah. Well, hopefully these GPs are sleeping well at night, because they know that their paperwork is shored up. Now, all I do is provide the paperwork, advice about how you build relationships, what general partnerships look like, what possible brokerage and other things look like. The SEC is abundantly clear that as long as you are an affiliate and working part and parcel with the issuer, that it's not deemed to be brokerage. Okay. And so again, major decisions, day-to-day responsibilities, participating substantively in the affairs of the business, meetings, just regular correspondence to show the cohesion and cohesiveness with the general partnership. Anybody could try to look under the hood at any general partnership for that matter and try to pick apart who's doing what. They're not trying to call all the balls and strikes there. They'll know, and it's obvious when the design and program has been to conceal brokerage. Okay. Secondly, we're talking about, really the real risk, Julie, are the operators who had a variable rate loan in a bridge product and didn't buy a rate cap.
Mm-hmm.
Okay. And we're also talking about a much more narrow pool because we've only seen a tumultuous rate cap market since probably February 20th or something thereabout of last year. So we're only talking 12 months. Some lenders are stupid. Sorry to say. Why would you not require a rate cap when it's like a paragraph in your loan agreement? Okay. Are you just trying to loan money just to get it out? What's the deal? Because you increase inherently the risk on your own loan product by not requiring a rate cap. And you didn't do it at a time that rate caps were affordable. Now they've tripled in cost and now they're almost impossible to underwrite. And now no lender is going to do a variable rate loan because nobody's shopping for them because you can't get a rate cap and they're now requiring pretty much across the board that you get a rate cap agreement. Okay. So there's a very narrow, I think, unfortunate pool of people who found themselves in that position.
So you don't think this is bigger than narrow?
I don't think it's that. I don't see it as that rampant. Honestly, I've got a couple of clients that were exposed without a rate cap, and guess what they did? You refi into a fix. Are you paying more in fix? Maybe, but it's a hell of a lot better than the variable rate loan that you're in now. At whatever SOFR plus, plus your whole life. So
They
so
didn't have-
no.
They didn't have rate.
I mean,
They didn't have a capital costs.
I've got a client that's their mortgage literally doubled on their property. And so they're refining with the same lender from a variable rate, and the lender didn't require a rate cap. Shame on these debt brokers out here, okay, who are not recommending rate cap products in their variable rate loans that they're pushing. And Julie, there's opportunities to get paid from the rate cap providers. So what are these people doing? You need to coach them all. Okay. That's all that stuff makes no sense to me. Okay. But it's the operator's job, and it's my friends on here and my prospective clients and my current clients. It's your job to be scrupulous. Ask these questions of your debt brokers. If it's ever a variable rate, ask what's going to be the rate cap. Not is there a rate cap requirement? How much can we get a rate cap for? Underwrite it, pin it in, not pencil it in. And if it doesn't work out, then you got to move on to a different product. I don't really see. I mean, and I don't really know the derivatives market that well, honestly, Julie. But I don't know how long it's going to take to get the rate cap market back. And things like the SVB bank and all that stuff only adds to the volatility and the uncertainty of the market. And anytime there's uncertainty does not lend itself, in my opinion and experience, to solid value. Generally, you're overpaying because people are trying to put in incalculable risk in the product. So variable rate loans right now are really pretty tough. So try to refi. Again, the fixed is going to be higher. I get it, but buy the rate down, get the LTV lower, go raise more capital. I mean, there's ways to do it. I've got clients closing stuff all, left and right.
So here's my question to you. Case study. Bank holds on to draw 2, 3, 4 months. Can't do any work. Then they take your future funds and throw it into your principal. Now you're paying on your principal this money that you couldn't even use because they were holding on to your draws. Now you're
they
paying.
didn't release.
Right. What does the general partner have? can they go after the banks and say, you're not playing fair. You put me at risk. You held on to my money. I couldn't get this money. I couldn't get any of the work done. You didn't give me my money back. I didn't have access to it. What safeguards
gotta
does
go.
the general partner have?
Well, so that's where you try to engineer the loan agreement itself. That's where you're trying to go through and work on the documents on the front end. You could make a stink with the lender themselves about it. I don't know from a litigation perspective if you could declare that a default on behalf of your lender, but they do have an obligation if the loan terms, you know, provide for the release of the draw. If there's some language where it's like discretionary and it, to the extent available, you know, that's kind of it. It's almost like the draws are prospective. They're not realized, but it's a little too tough academically to talk about the implications because loan agreements can vary so much in language and how they're designed. That what I would do as the practitioner is send me your loan agreement. Let's take a look at this. What did we contemplate in the draw schedule? And did the bank have obligations? Did they have any disclaiming language? And so that's how you run that path. Concurrently, you're going to your investors, and I think unfortunately, you know, you put it on your lender. If there were, generally that's not going to rise to negligence, certainly not going to rise to gross negligence, and it's absolutely not going to rise to an adjudication of an unfit manager where they're being administratively removed as the manager, which most operating agreements provide for, right? And removal only by a final order, you know, of a court of competent jurisdiction. Even variable rate stuff when you didn't get a rate cap is not grossly negligent. You signed all of the loan documents and the rates shot up.
Yeah.
I mean, when you were buying those loans, you know, in Q3, Q4, 2021, I mean, we just didn't know that. We kind of suspected that February was coming, but we didn't know. So people were like, oh man, if it goes up a bip, who cares? You know, then it went up like a couple hundred bips, right? And so it's like, you know, it got real. But these are questions that you can have. The nice thing is that the lenders still have to be lenders. They still have to save enough face to make these loans. And they know that, like, if you get a bad rap as a lender, like it's not a good look. Then your quality of borrower is going to diminish. And then that's when people are like, okay, I guess we're subprime now because nobody of quality is going to come borrow from us. And so I think there's a certain kind of reputational component, you know, that's factored in as well, where they should be doing the right thing. But you can always have your attorney send a letter and just say, listen, here's the draw schedule and you guys are missing it. If nothing else, we're reserving any rights under the loan agreement to exercise any default, anything moving forward. Please put the draw in, something like that, and kind of, you know, flex.
That is really good information. I think what is really important on these bridge loans, and we're going to close this up here shortly, is the loan agreements on bridge loans, on debt funds, is very different than agency loans. These are boilerplates. They have been in existence for years and years and years. When you get to debt funds, everyone is different. It's just like a bank loan,
right.
All different. So you really have to have your own eyes, your attorney's eyes, you have a broker's eyes on it, and everybody has to be looking at it and having input on it. So
that's why I like our collaboration, and I like that we talk about these things and we're able to speak on them in real time with the documents. And that's where the fee is earned, because there are too many intermediaries and advisors that just kind of plug in and play and sit back. The fun is in the details. The fun is in knowing that what the product that you got the client in, and that how we've got their documents, that they're shored up and protected. I mean, you just know, just committing to that just already establishes an awesome foundation for a really good reputation. And you have that. I'm trying to build that. And it takes that team effort. Yeah, for sure.
Yeah. All right. Well, awesome. Anybody have any questions? We've covered a lot. This is a really full, excellent conversation. Anybody here? Kyle, you always have questions. Anybody? Charles?
I answered Kyle's questions already on the phone, I think,
Good.
last week. I got to
Yeah,
follow up. I think
I'll jump
I
in.
got-
Nick, good to see your face after talking last week.
Yeah, man.
So for the newer syndicator, newer GP, we're out there talking to friends, family, coworkers, neighbors, soccer coaches, et cetera, et cetera. Can you just go back and really baseline what the relationship has to be? Like if I know somebody for 10 years, tell him what I'm looking at doing. He's like, yeah, I want to get involved. My friend wants to get involved and stuff like that. We go all have dinner. We have a casual conversation, discuss what could happen. It's not the actual deal. It's just like, hey, this is some things we're looking at. 100-unit apartment, 7% cash on cash, 5-year refi, maybe 7-year hold. We don't know. This is what we're trying to do. And then 6 months later, we have an actual deal. And I go back to that person and present. Is that qualifying the exemptions that you're referring to, or is there a lot more legwork that has to go into establishing the relationship appropriately?
No, I mean, I think that would work perfectly. I mean, remember the hallmark is, think of it this way. If you in good conscience could be sat down by a regulator and say, yeah, I know them. Yes, I solicited them for the investment, but that's because I knew them. And I also knew that at the time I made the investment, they knew exactly what they were getting. We talked about, here's the property, here are the returns, here are the fees that I'm going to earn as the manager, here are the distributions that you're and they're going to earn as a limited partner. And I knew that at the time of subscription, that they had full visibility into what we were doing. That's where you want to get. So what you're talking about and what you're doing is absolutely perfect. You have a foundation. Maybe it's around real estate, like the people that you can collaborate with here in this room. And maybe it is just, somebody at your kid's soccer team, and talking with a parent. I was talking to, Saturday, you just get to chatting with, we were at baseball and you just start talking to, one of our kids' teammates' dads, right? And you're going to see them again and you chat about it. Did I hand them a PPM? Like, no, but that would be weird anyway, right?
Yeah.
So you just kind of chat with them about it and just get to know them. And so when you make the investment, they're like, hey, I've got some credibility and seems like a solid guy. And you really walked me through, kind of what these real estate deals look like and knew, that I was ready for one by the time the solicitation came down the line. But it sounds to me like, what fits, but you can also call me or shoot me an email if you've got some different facts and you're unsure of it. But if you stick with that program, you'll be aces.
Cool. Thank you.
Anybody
Amen.
else?
Good question.
Okay, so if somebody wants to do business with you, I mean, why wouldn't they, right? But if somebody really wants to do business with you, how would they get a hold of you other than me giving them your cell number, which probably shouldn't be doing, but
Just
I
give
always
everybody my
do.
cell.
And you're like, what? Oh, okay.
What personal life? I mean, what kids and wife? My wife already texted me. She's like, you need to wrap it up. But she's the
Thank
only
her.
reason I'm
Thank her.
I'm even good at what I do. But look, just maybe connect with me on LinkedIn. Nicholas G. Moore, Robinson Franzman. That's probably the easiest spot. I try to check that. I'm not always, putting super engaging posts, and there's not all these like legal updates and stuff like that I think I wish, I think ideally I hope I get to a point in my career where I can, have the time to do stuff like that. Right now I'm grinding with you guys. I'm straight up grinding with you guys.
Yeah.
Let's get in here, let's find these deals and let's do them right. My email, you can DM me on LinkedIn. My email, I can drop it in the chat here. And you can shoot me an email, shoot me any questions, any deal flow. Again, I've got, make sure I spelled that right. I've got, a great staff. We're headquartered in Atlanta. We have a national practice. I don't have to live in your state to transact business there. Any of the title stuff, again, we source that locally so that all the recording and all of that is comports with state law. But I've got clients that span the nation, and man, I'm hungry. I don't turn anybody away. We'll figure out a way to get the documents to you. You send me the deal, we'll figure out the rest. But this has been awesome, very engaging. I love how there's so much dialogue and it's not, super monologue-y.
Well, no, we don't like that. We like getting it out there, and I
That's
love when
right.
you come and do your thing. So I appreciate you joining us tonight, and always such a pleasure to learn from you. And we're gonna do one breakout session. I know you got to run, but if you guys make sure, and this is for those of you who are listening to this on our YouTube channel, it's Nick, N-I-C-K, at RFLL. That's RF as in Frank, LL, P as in Paul, Law, LAW.com. That's how you get a hold of Nick. Okay. And again, Nick, thank you so much. You're a real winner and a great supporter of mine, and I love what you do
Heck
for
yeah.
me and my peeps. So keep doing it.
Well,
I really
heck
appreciate
yeah,
it.
we'll keep doing this. I hope to see you at a conference sometime soon. Check the dates on the IM in Atlanta. Please come down. It'd be great. We can grab
Okay.
coffee or grab a breakfast or something before the conference. But we'd love to host you, and good luck in IM in Dallas next week. And I've already seen some nice messages from everybody, and everybody's been very gracious tonight. So the pleasure's all on this side of the table.
Thank you so much. Tell your wife thank you. Appreciate her.
I sure will.
Okay,
I sure
everybody.
do.